P&D Company, a partnership firm in Nagpur, Maharashtra, is a wholesaler of taxable product P and product Q exempted by way of notification. So product P is a taxable product, whereas product Q is an exempted product. The firm supplies these products only in the eastern part of Maharashtra. All the procurements, both goods and service of the firm, are from the suppliers registered under regular scheme in the state of Maharashtra. So actually this B&D company is now into composition scheme. The firm pays tax under composition scheme, but whenever they are making the procurement is fully from a registered person. B&D company has furnished the following details with respect to its turnover, exclusive of taxes, and stock exclusive of taxes. Particulars P and Q. Turnover for the quarter ended 30th June. Turnover for the quarter ended 30th September. So we have the turnover. And you need to remember something here, that composition scheme is applicable whenever our aggregate turnover is up to 150 lakhs. After crossing the aggregate turnover of 150 lakhs, we are disqualified from the composition scheme and we will be going into normal scheme. So here, what is the turnover for the first quarter? So for the first quarter, it is 77,65,000. Should we even take exempted goods into the turnover? Yes. Aggregate turnover is not only taxable but also exempted. So total should be taken. And again, by 30th September, so you need to add further 67 lakhs. So therefore, what will be the total turnover as on 30th September? The total turnover as on 30th September, so is 1 crore 44 lakh something. So it is a turnover here. So the turnover as on the date. So can you please tell me what is the turnover as on the date? Yes. So 1 crore 44 lakh 65,000. 1 crore 44 lakh 65,000 is the turnover. Whether it crossed 150 lakhs? No. It did not cross 150 lakhs, which means still they will be into composition scheme only. Now, what is the stock as on 30th June and 30th September and 31st October is given. The entire stock of product P and Q available with the firm as on 30th September is purchased during the said half year except a consignment of product P valuing 3 lakhs, which was purchased in April month of the preceding financial year. The said stock could not be sold during the month of October. In the current financial year, in the month of October, no purchases were made and the products were sold with a profit margin of 20% on sales. The extract of the only bill book maintained by the firm showed the following details. Now we need to know exactly on which date they are coming out of the composition scheme and going into normal scheme. Why we need to know this data? There is one section 18 subsection 1 clause C. What does it say? If you are under composition scheme and if you are going into normal scheme, at the time when you were into composition scheme, so whatever is the purchases that you have made on that purchases, so GST paid would not have been taken as credit. Now that continued to be in the closing stock before the date you are going into normal scheme. So using that closing stock only, you will make the outward supply after the date you are going into normal scheme. So therefore, logically on the closing stock, we should take the credit. So therefore, we will take the IDT with respect to raw material or inputs as such trading stock, inputs in WIP, inputs in FG, and even on capital goods, we will take the credit as reduced by capital goods as reduced by 5% for every quarter or parcel from the date of purchase till the date of conversion. Okay. But in case of inputs, we will not reduce anything. And these goods should have been purchased within 1 year prior. So that is for the closing stock date, it should be purchased within 1 year prior. So now what is the closing stock date? First we need to know the date on which they are coming out of the composition scheme. Okay. Now, as on 30th September, 1 crore 44 lakh 65,000 is their turnover. Now, for this 1 crore 44 lakh 65,000, if you add 2 lakh 3,000, so that will be 1 crore 46 lakh 68,000. And then add 1,38,250. That is 1,48,06,250. Then again, it did not cross. So add 1,06,250. So 1,49,12,500. Then add 92,500. So 1,50,05,000. So therefore, exactly on 3rd October, because of this invoice number or bill number 2309, we are crossing 150 lakhs. So therefore, 3rd October is the date on which we are crossing 150 lakhs, and that is the date on which we are crossing composition scheme and entering into normal scheme. So before the date should be taken as the closing stock date. So the closing stock date is 2nd October. So on 3rd October we are crossing 150 lakhs. So on 2nd October we need to take the closing stock. Okay. So mainly for determining which date we need to do this computation. Okay. And remember, while calculating aggregate turnover, we need to include even exempted supply also. Now 2nd October. We need to take the closing stock as on 2nd October. Okay. Now, what is the information here? We have the information of the stock as on 30th September. So therefore, opening stock we have plus purchases minus closing stock equals to cost of goods sold, or minus cost of goods sold equals to closing stock. Okay. Opening stock plus purchases. So opening stock plus purchases, opening stock plus purchases minus cost of goods sold equals to closing stock. So this closing stock only we need as on 2nd. First, what is the opening stock? The opening stock is nothing but, on 30th September. But no need to determine for Q. Why no need to determine for Q? See, first of all, try to understand the GST paid on closing stock, whatever is there, GST paid on the closing stock will be availed as ITC. As Q is an exempted product, definitely on its purchase, we would not have paid GST. As P is a taxable product, on its purchase, we would have paid GST. So therefore, we need to take ITC only with respect to P. What is the opening stock? 10 lakhs. As on 1st of October, it is 10 lakhs. Add purchases. We need to see whether there is any purchases during this time. So they have given one word, that is, so no purchases were made in the current financial year in the month of October, which means that the purchases will be 0 minus cost of goods sold. So what is the sale for these 3 days? For these 3 days, the sales is 2 lakhs. Only product P. Because about product P only we are talking, because product P only the GST has been paid. So 2 lakhs plus 1,33,000 plus 67,000, that will be 4 lakhs. Okay. But 4 lakhs don't deduct, that is the sale value. We need the cost of goods sold. So here, what is the profit margin? 20% on sales. So therefore minus 20%. 4 lakhs minus 20%. 3,20,000. Okay. So 3,20,000 needs to be reduced. So that will be the closing stock. So 10 lakhs minus 3,20,000, 6,80,000 will be taken as the closing stock here. But on the 6,80,000 GST paid cannot be taken as credit, because in the 6,80,000 we need to see what is the purchases of goods which is lying in this closing stock, and that purchase should be within 1 year prior to the closing stock date. So what is the closing stock date? 2nd October. See what are the goods which are purchased within 1 year. So you read this paragraph. The entire stock of product P and Q available with the firm as on 30th September is purchased during the half year, except a product P valuing 3 lakhs which was purchased in the April month of the preceding financial year. So it is beyond 1 year. So therefore, from this 6,80,000, you need to take out 3 lakhs. So because this 3 lakhs worth of material is purchased before 1 year, on that we cannot take ITC. So remaining 3,80,000. So 3,80,000 into what is the rate of GST? So here we need to know the GST rate here. The GST rate is not given, so we can take 18%. In the absence of information, we can take 18%. So 3,80,000 into 18%, 68,400 will be taken as the credit. Okay, 68,400. That is 34,200 and 34,200. 68,400 will be taken as credit under 18(1)(c). Clear? So that is with respect to this. Actually, here the question is that only. All the above items are exclusive of GST. Compute ITC credited to the electronic credit ledger of the BND company when it exits composition scheme and becomes liable to pay tax under regular scheme in accordance with the provisions of 18(1)(c). And how to take this credit? This credit will be availed by filing a form GST ITC 1 within 30 days from the date when we are migrating from composition scheme to normal scheme. And if the ITC amount exceeds 2 lakhs, that should be duly certified by a chartered accountant or a cost accountant. So in this case, ITC amount is just 68,400. So that need not be certified by a CRCMA. If it exceeds, just a self-certification. If it exceeds 2 lakhs, that should be certified by a CRCMA. Okay. That is with respect to this question.